So let's take a look at goodwill impairment. This is not what happens when goodwill gets drunk or has too much to drink at night. But this is essentially what happens is when we have an asset where there's potentially a decline in value. And with goodwill, unlike patents that are amortized, right? So when we look over here at a patent, which is intellectual property, we go through and we amortize the patent over the lesser of its useful or legal life. When it comes to goodwill, we're going to go through and we're going to essentially do a test of impairment, meaning that has this goodwill lost any of its potential value? And so a lot of times this is going to be done based on future cash flows. Generally, for most companies that go through and do this, if you do, management will generally do a quarterly impairment testing. However, most auditors will require management to obtain an outside opinion or appraisal for goodwill impairment. So let's go ahead and take a look at what we've got here. So on 12/31/30, after operating the PDX business for a little over 2 years, YYZ is deciding to potentially sell the business. The net assets of the PDX business as of 12/31/30 was as follows. So they have total assets of 4,658,33. They've got, including the goodwill, they have liabilities over here of 825,000. So the net assets of the business are basically what it's on our books for is 3,825,833. Now we received an offer to purchase the business for 1,825,000. The offer would assume the assumption of the accounts and notes payable. YYZ's management believes that the offer is fair. So this is what it's showing right now on our books, right? So again, when we have, and this is what you have to kind of go through and remember, when we're showing our assets, right, our assets, liabilities, and equity, we're really making a representation to our investors that the assets are what they are, that they, I want to say that they have value, but it's like we believe that this goodwill has value. Now, obviously, you're running your business, and we can look at like Macy's is a great example. You can look at their goodwill balance, how it went down from, I think, like almost like over 10 billion down to like less than a billion over time. Again, not all acquisitions are going to work out. Some work out, some they don't. But if we come over here and we now look at our situation here with PDX, they're showing net assets, and this includes goodwill. Right? So this includes goodwill, but the fair value of these assets on 12/31 is 1,825,000. Okay. So basically the adjustment or the change is going to be basically a little bit more than $2 million. What does this mean to us? Well, the value of our goodwill, that was 2,155,000. This goodwill has clearly become impaired, meaning it doesn't have the same value it once did when we went through and purchased the company. So what we need to go through and do is, when it comes to goodwill, is we're going to go through and impair it, right? So the question becomes is like, well, I need to go through and basically show that essentially that over here, that basically the value of my net assets is essentially going to be 1,825,000, right? So if I go through and say, well, the change in the fair value, right? So if I impair goodwill by this 2,833,000, my new value of goodwill is 154,167. So if I impair goodwill, remember goodwill is an asset, and I basically going to impair it by crediting goodwill by this, so that my new balance of goodwill is 154,167. Then after I go through and do this part over here, the net asset value of what I have is now worth 1,825,000, right? So this is essentially post impairment. So if I make this impairment to goodwill, I essentially going to have over here, my goodwill now has a value of 154,167. So on my financial statements as of 12/31/30, what I'm going to do is I'm going to debit goodwill impairment or impairment of goodwill. And then I'm going to be going here and crediting goodwill. And I'm going to do this by saying 2,833,000, 2 million on both sides. Now, what you want to do when you get these types of questions is I kind of recommend it's like, hey, plug in the numbers to make sure that, well, if this is the value of the net assets, if after impairing it is my new net asset value, what I'm saying what the fair value of the business is, that's what I would want to go through and do. In the event, say the fair value is even less, I would just write off the goodwill to zero. Now, what about the other assets? Would I need to write those off as well? That probably would take a little bit of a deeper analysis, but I think goodwill is one of those balances that it just reflects the over how much we paid more than the identified fair value of the assets. As long as these values here still have value, I'm not going to go through and impair those different assets. Rather, my focus is really truly going to be on the goodwill of the business. So again, what you do is you say, okay, what's the net asset value? Assets minus my liabilities gives me net assets. I compare that to the fair value, right? And then the difference between these two is what my goodwill impairment will be. My goodwill has a debit balance, it's an asset, I impair it. So this is my new balance. When I put in that new balance into goodwill, I want to make sure that my net assets now reflects the fair value. Okay. Now, when it comes to this over here, which is the next question, it's like, well, what if a year from now, we now believe that this is basically valued at 2,250,000? So if I wrote it down, can I now write it up by 425,000? And the answer is absolutely not. Once you impair goodwill, there's no further recovery of it. You don't recover it. You just impair it. It's done. It's gone. We don't go back through and add it back. Couple other things when it comes to goodwill impairment. Depending upon how materially significant this is to net income, you may want to identify it separately as other income. And let me just pause real quick. I'm going to try to see if I can find this for Macy's. So if we look over here at Macy's and if we look at their balance sheet, we've got February 1st, 2020, they had about 3.9 billion of goodwill. And if we went back even further, this was even higher. But as of now, they've got about 838 billion within just this short period of time, basically within a quarter from February 1st to May 2nd. So they obviously had a decision. They said, hey, our goodwill is no longer worth this value. We're going to go through and impair it. So when you look at this over here, when it comes to like cost of sales, basically impairment, restructuring, and other costs, they are going through and identifying this separately. And when you do a materially significant impairment, and clearly this is materially significant because you're talking about a roughly, what is this? This is roughly about over a $3 billion hit. I mean, it's almost the entire reason that they had like this net loss during the quarter ended May 2nd, 2020. And this may have also kind of occurred because it was kind of like the start of the pandemic. They just said, okay, we're just going to go ahead and basically clear this out. But again, it's when you go through and you recognize this, it's essentially when you have this huge net loss. If you look at it from a cash flow perspective, it doesn't really hit cash. And it's because if you look at the entry essentially itself, you're basically debiting it's essentially you're going to show this as an add back to on the statement of cash flows because there's no real cash impact of the impairment. It's going to essentially hit the P&L, the profit and loss statement basically for that. So again, when it comes to impairment, what you want to have happen, we're going to look at basically the net assets. We're going to see if we can come up with a fair value. We'll write down goodwill essentially down to zero. We don't write it down beyond that. If we did have, if this fair value was like $5, then we'd have a big problem because it's like, well, are these assets now worthless? Like what's happening here? And the other part of this too is when it comes to asset impairment, we also do not show a recovery. So once we impair it, we're not going to go back through later on and show an asset recovery. So that is goodwill impairment, and I will see you on the next video. Have a great day.